Today's hearing. Mr. Thornton has gone through the basic rules of our remote hearing today. Staff has been instructed not to mute members except where a member is not being recognized and there is inadvertent background noise. Members are reminded that all House rules relating to order and decorum apply to this remote hearing. Before we begin, I want to take a moment and talk about our subcommittee and the road ahead. This is our first subcommittee meeting. This is the first time I have chaired a subcommittee. And I want to say to my friends on both sides of the aisle, my door is open to everyone. This subcommittee will cover a lot of important issues, and there are many opportunities to work together. As we turn the corner on the pandemic, we must ensure the financial system remains stable. Next, there must be equity in the recovery. This means a Community Reinvestment Act that works to root out discrimination and empowers minority deposit institutions and community development financial institutions. It also means strong consumer protections and making sure everyone has a chance to share in the recovery. Last, the pandemic has shown how important access to financial services is. I look forward to working on helping unbanked and underbanked communities gain access to banking services. I am also pleased the ranking member of this subcommittee is my friend from Missouri, Blaine Meyer. I look forward to working with you, Blaine, and I think we can do a lot of good things together. The title of today's hearing is Slipping Through the Cracks: Policy Options to Help America's Consumers During the Pandemic. So now I'll make my opening statement, and I recognize myself for 4 minutes. Just this week, a constituent of mine called my office, and this really occurred. We'll call her Mrs. McGillicuddy. She was looking for help. Mrs. McGillicuddy called because, like many Americans, she lost income during the pandemic. She couldn't afford her car payments anymore, and her car was repossessed. If that wasn't enough, she is being charged an additional $500 repossession fee for the privilege of having her car taken away. One of the words Mrs. McGillicuddy used to describe her situation was unfair. And she's right. Her situation is unfair, and the virus is unfair. COVID-19 has impacted Americans from all walks of life, but it has disproportionately affected lower-income Americans, communities of color, and service sector workers who have continued to work in person throughout the pandemic. For many of us, we're doing okay, and the vaccines are a light at the end of the tunnel. But for millions of Americans who have lost income, savings, or opportunities, there is a long road to recovery ahead. As of today, more than 10 million Americans are still out of work. 29 million Americans have gotten sick with the virus, and COVID-19 has claimed the lives of more than 500,000. This is the health and economic crisis of our lifetime. Congress has passed several laws providing relief to consumers and small businesses, including yesterday's historic American Rescue Plan. These packages have included forgivable small business loans and direct payments to individuals and families. But even these relief efforts have further illustrated a world of haves and have-nots in our country, particularly with financial services. For small businesses with strong relationships with financial institutions, they were the first to get access to the Paycheck Protection program. For folks with bank accounts linked to the IRS for direct deposits, they were the first to get their economic impact payments. And if you didn't have a good relationship with a bank or a credit union, you had to wait, and some are still waiting. The purpose of this hearing is to explore gaps in consumer protections during the pandemic and to evaluate policy responses to ensure all consumers and small business owners can get through this period of uncertainty and share in the economic recovery. The hearing will also address racial and economic disparities exacerbated by the pandemic. Specifically, today we will explore issues in debt collection, credit reporting, private student loans, non-agency-backed mortgages, small business, and commercial rent. Let's go back to my example of Mrs. McGillicuddy for a moment. She had her car repossessed and owes fines on top of that. But without a car, it's more difficult for her to get a job interview or to get to work once she's employed. This will prolong her financial recovery. Now picture her situation for millions and millions of other Americans who might be slipping through the cracks and facing similar financial challenges. This will hurt those millions of individuals and families and also do damage to our economy as a whole. If we want a full recovery and an inclusive recovery, we must have comprehensive and thorough consumer protections. It is now my pleasure to recognize the ranking member, Mr. Luke Meyer, for 5 minutes for an opening statement. And I yield back.
Thank you, Mr. Chairman, and congratulations, Congressman Homeowner. Ed, you and I have been friends for a long time, and I'm looking forward to your chairmanship, your common sense approach to things, and hopefully we can do a lot of good for the good citizens of the state and our constituents and the economy as a whole. I look forward to your leadership. The country is finally beginning to open up. Currently, we have administered more than 90 million vaccine doses. States across the country are beginning to lift their lockdowns, and we are starting to get back to business as usual around the country. As we begin to put the coronavirus pandemic behind us, it is appropriate to measure how consumers and businesses have fared over the past year. It is true that the pandemic has hit certain consumers and businesses harder than others. For instance, part-time workers especially have been hard hit. Commercial real estate, including restaurants and other small businesses, have also struggled. I welcome conversations that examine what Congress can do to help these sectors and consumers. I believe that there are meaningful bipartisan initiatives this committee can work on to improve how consumers and businesses can get better access to the financial system. Unfortunately, when I looked at the 18 pieces of legislation attached to this hearing, I didn't see meaningful efforts to improve financial access. Instead, the majority has decided to retread policies from last year's HEROES Act that have no chance of becoming law, even with Democrats controlling the House, the Senate, and the White House, and seek to fundamentally alter key aspects of the lending market that will only limit access to credit for low and moderate income Americans. One of the most concerning trends of the legislation attached to this hearing is the erosion of the accuracy of consumer credit files. As I've noted many times in this committee, eliminating valuable credit information would mean that lenders will not have access to information to determine creditworthiness of borrowers. In those instances, lenders will be forced to increase the cost of credit to account for the additional risk on an incomplete credit file. This will ultimately decrease access to credit for those who need it most. Furthermore, Congress has already taken action to protect the credit files of consumers during the pandemic. Section 4021 of the CARES Act protects borrowers from negative credit reporting that results from loan accommodations made during a national emergency associated with COVID. The CARES Act also requires lenders to report accounts with an accommodation as current to the credit bureaus if the borrower is meeting the requirements of the payment plan. Another dangerous trend my colleagues on the other side of the aisle are pursuing is related to debt collection. Multiple pieces of legislation attached to this hearing would suspend or prohibit debt collection. What my colleagues fail to realize is the majority of the debts being serviced by debt collectors originate from small businesses that do not have the means to collect the debt themselves. In addition, prohibiting debt collectors from communication with debtors eliminates the ability of collectors to work with consumers and get them on a path to repay their debts. Let's be clear, payment for services rendered is a fundamental premise of the free market system and a functional economy. No business can survive if they cannot collect the money owed them for their services. As I said before, I welcome the conversations to improve access and functionality of the financial system. I believe there are bipartisan solutions to increase transparency and functionality in both credit reporting and debt collection, while still maintaining the fundamental principles of lending in a free market economy. For example, in just the past few years, we have seen innovation in financial services increase due to increased access to low and moderate income consumers. For the uses of alternative data and credit reporting, the rise in mobile banking, to fintech partnerships, financial products are adapting to serve the consumers who need it most. If my colleagues truly want to have conversations around ensuring consumers do not slip through the cracks, I believe this committee should focus on common sense solutions that seek to broaden the pool of individuals involved in the financial system and drive upward mobility for all Americans, as opposed to increasing government control over our finances and countless roadblocks to financial services. Furthermore, it is in a truly partisan manner. None of the legislation attached to this hearing was introduced by a Republican. Failure to allow Republican measures to be attached to this hearing prevents this committee from having conversations with subject matter experts on the merits of these bills. One such piece of legislation introduced by Ranking Member McHenry, the Protecting Consumer Access to Credit Act, will remove non-elective medical debt from a consumer's credit report and grant the CFPB authority over the cybersecurity efforts of the credit reporting agencies. I'm disappointed we will not be able to discuss this legislation and other common sense bills at this hearing. With that, I look forward to hearing from the witnesses today on the panel. And with that, Mr. Chairman, I yield back.
Thank you. The gentleman yields back. I'd like to yield 1 minute to the chairwoman of the entire committee, Ms. Waters from California.
Thank you, Chairman Perlmutter. Your leadership of the Consumer Protection and Financial Institutions Subcommittee is starting off strong with your first hearing as chair. Congratulations. While we have reason to be hopeful about the future, the pandemic is still raging and consumers and small business owners remain vulnerable. Under the leadership of President Biden and Vice President Harris, Congress passed this week H.R. 1319, the American Rescue Plan Act, to boost the pandemic response and provide additional support for workers, consumers, and small businesses. However, additional borrower protections could not be included in the bill given the limitations of the reconciliation process. And Congress and the administration have lots more work to do to help consumers, small businesses who are most in need, especially those communities of color, which have been hit the hardest by the pandemic crisis. So I look forward to hearing from our witness today, and I yield back the balance of time. Thank you.
Thank you. The gentlewoman yields back. And for our witnesses today, thank you very much for being here. You've heard some buzzers in the background. Earlier, I mentioned to you all, we are having a whole series of votes on the floor, so there'll be a little coming and going of members as people go to vote. We'll try to keep things moving along as much as we can without interruption. But it'll be a little bit interesting for my first hearing to have all these votes. Now, I want to welcome each of our witnesses, and I am pleased to introduce our panel. Ashley Harrington is the Federal Advocacy Director and Senior Counsel at the Center for Responsible Lending. Thank you for being here. Robert James is the President of Carver Development, CDE, and Chairman of the National Bankers Association. Thank you, sir, for your attendance. Carla Sanchez Adams is an attorney and a team manager of the Survivor-Centered Economic Advocacy Team for Texas Rio Grande Legal Aid. Thank you for being part of our panel. Valerie Schultz-Wilson is the managing partner at Schultz & Company, Nonprofit Management Consultants. Appreciate you being here. And Joel Griffith is a research fellow at the Rowe Institute for Economic Policy Studies at the Heritage Foundation. We thank you all for joining us. Witnesses are reminded that your oral testimony will be limited to 5 minutes. You should be able to see a timer on your screen, and that will indicate how much time you have left, and a chime will go off to alert you as well. I would ask you to be mindful of the timer and quickly wrap up your testimony if you do hear the chime, so that we can be respectful of your time and others. Without objection, your written statements will be made part of the record. And once the witnesses finish their testimony, each member will have 5 minutes to ask questions. And without objection, I'd like to introduce into the record letters that we received dated March 10th, first from the Consumer Bankers Association, signed by Mr. Richard Hunt, President and CEO, and a letter dated March 10th, 2021 from the National Association of Federally Insured Credit Unions, signed by Mr. Brad Thaler, Vice President of Legislative Affairs. Without objection, they'll be entered. So I'd like to begin with you, Ms. Harrington. You now have 5 minutes for your testimony.
Thank you. Good morning, Chairman Perlmutter, Ranking Member Meyer, and committee members. I also want to thank Chairwoman Waters and Ranking Member McHenry for their leadership of this committee. Thank you for the opportunity to testify for today's hearing. I am the Federal Advocacy Director and a Senior Policy Counsel for the Center for Responsible Lending, an affiliate of Self-Help, one of the nation's largest community economic development lenders. A year ago today, the World Health Organization declared that we were in a global pandemic. In the past year, we have watched as the number of lives lost grew to an alarming 520,000 souls, and as families and communities struggled to adjust to a new reality. The economic crisis caused by COVID-19 has devastated the financial lives of millions of Americans. We've seen the images: long lines of cars outside food banks, the shuttered storefronts of restaurants and other small businesses, and people sleeping in parking lots in the shadow of empty Las Vegas hotels. People have lost their jobs at a nearly unprecedented rate. Many low-income renters and homeowners have been unable to make their monthly payments, racking up debt and praying for a change in fortune. The financial devastation from the COVID recession has not been evenly shared. The pain has been most acute for Black, Latino, and low-income Americans, as well as women, groups that typically had far less of a financial backstop to begin with due to ongoing systemic inequities. Black women and Latinas are especially suffering and currently have the highest unemployment rates of any group. Federal policymakers have responded with relief that has been both essential to preventing additional widespread suffering in the form of another Great Depression and also insufficient in meeting many basic human needs. Lawmakers should be commended for these urgently needed relief packages, including the just passed American Rescue Plan. But packing it up and calling it a day would ignore the precarious position in which countless families find themselves. To sufficiently protect American consumers and set the stage for an equitable recovery, policymakers must take a range of steps. These include straightforward, common sense actions, such as extending the Paycheck Protection Program, which will expire at the end of March, and ensuring that the many very small businesses have the chance to get full loans under the recently fixed Schedule C solution. Requiring that private mortgage loans adopt the foreclosure moratorium and forbearance policies offered by Fannie Mae, Freddie Mac, and the FHA, as well as mirror the federally backed loans in providing a post-forbearance solution that does not increase borrowers' monthly payments. Addressing the nation's student debt crisis, starting with executive action to cancel $50,000 per federal borrower, and ensuring that relief is extended to private student loan borrowers and other federal borrowers who have thus far been excluded from federal support. Stopping banks from gouging consumers with overdraft fees that are unreasonable, harmful, and regressive through comprehensive reform, including a limit on the number of fees that can be charged. And before a fast approaching spring deadline, using the Congressional Review Act to overturn a 2020 OCC rule that severely weakens state usury laws that protect people and small businesses from predatory high-interest loans, and exempting consumer stimulus payments from assignment and garnishment by debt collectors. These steps will help everyone as we work to move from rescue to recovery. They will be particularly impactful for people of color and low-income, low-wealth people who have had to bear the brunt of every crisis we have faced, including this one. This is a watershed moment. We get to determine how we respond to a crisis that is compounding long-standing inequities that have plagued our country for centuries. We get to prove that the lessons of the Great Recession will not go unheeded. In short, we get to do better. The policy choices made now will determine whether the next new normal will look more like the old status quo, or whether economic opportunity and financial stability are widely available to everyone. Thank you. I look forward to answering your questions.
Thank you, Ms. Harrington. Mr. James, you are now recognized for 5 minutes for your testimony.
Thank you, Chairman Perlmutter, Ranking Member Meyer, Chairwoman Waters, and members of the subcommittee. Good morning, and again, thank you for this opportunity to testify on ways to protect communities and minority small business during the pandemic. It gives me great hope that one of this subcommittee's first hearings of the 117th Congress is shining a light on these critical issues. Again, my name is Robert James II, and I'm the president of Carver Development CDE, an affiliate of Carver State Bank of Savannah, Georgia. I'm also the chairman of the National Bankers Association. The NBA is the leading trade association for the country's minority depository institutions. Our mission is to advocate for the nation's MDIs and the communities they serve. Many of our members are also CDFIs, and have become the banks of last resort for the underserved. Our member banks are on the front lines, reducing economic hardship in vulnerable, hard-hit minority communities. Our banks, many of which have existed for over 100 years, are best positioned to help these communities recover and overcome many of the systemic issues that have placed them at an economic disadvantage. The House Financial Services Committee and Chairwoman Waters have been instrumental in the inclusion of several provisions in multiple relief packages adopted during the course of the pandemic that ensure MDIs and the small businesses and individuals we serve are not forgotten during this national emergency. Tier 1 capital, or the equity invested in a bank, is the most critical component of the resilience of any bank, and it's what allows us to grow and scale. MDIs, particularly African American MDIs, have historically lacked access to capital markets that would allow them this scale. Without sufficient Tier 1 capital, not only are banks limited in the amount of deposits they can take in, but they're also hampered in their ability to weather loan losses. In this unprecedented economic crisis, many financial institutions, particularly those in underserved communities, will have increased delinquent loans. The creation of the Emergency Capital Investment Program and the $3 billion in additional funding for the CDFI fund will help institutions like ours provide more access to credit for LMI communities. The NBA applauds Congress for the adoption of these two important measures, and we look forward to working with you on additional legislation to ensure that our communities experience lasting material changes that will support a broad and deep economic recovery for all Americans. As you know, the situation brought on by the pandemic is dire in our communities, and we need to do all of our part to ensure individuals in the middle of this health crisis, particularly minority communities that have accounted for over 50% of the deaths, have equal access to government relief funding. It is important to note that an average of 70% of minorities do not have a bank branch in their neighborhood, coupled with 94% of Black small businesses being sole proprietors that are typically underbanked. Given the challenges faced by small businesses, especially minority-owned small businesses, it's imperative to assess which banks are best placed to provide access to capital for these communities. This is especially true in the Black community. Unfortunately, our smaller size has not always allowed us to act as quickly or with as much scale as the current situation demands. We saw these disparities play out during both rounds of the Paycheck Protection program. Congress devised this program as a mechanism to aid small businesses who suddenly found themselves forced to close during stay-at-home orders. A set of conditions that have favored larger businesses, including many of the large banks only approving loans for existing customers, delaying the applications of sole proprietorships, and not allowing enough time for banks like ours to help our customers through the application process, shut out many minority-owned businesses. Recent efforts to expand eligibility in the PPP program have been welcomed, but our members need more time to help the smallest businesses. Many of our banks are seeing double the applications this round and see no way to get these customers served if the program sunsets at the end of March. We are also focused on the long-term recovery, which is why the MDIs and CDFIs need capital and need to be included in programs like the State Small Business Credit Initiative. We also recommend MDI-focused offices in agencies like the SBA and the CDFI Fund to ensure MDI access to these existing programs for, again, the long-term recovery. The MBA has recommended several potential solutions to Congress and the administration, including passage of the Ensuring Diversity in Community Banking Act, consumer, small business, and nonprofit credit enhancements, an MDI investment tax credit, fully supporting and funding the CDFI fund, federal deposits in minority depository institutions, and many others. The MBA, again, applauds the subcommittee for holding this important hearing and for the full committee's ongoing efforts to ensure equity for all businesses and communities. We look forward to working with you, and thank you for the work that you've already done. I'll be happy to answer any questions.
Mr. James, thank you for your testimony. Now we'd like to recognize Ms. Sanchez Adams for 5 minutes for her testimony.
Chairman Perlmutter, Ranking Member Meyer, Chairwoman Waters, and members of the subcommittee, thank you for inviting me to testify today on behalf of my organization and the low-income Texan consumers we represent. My name is Carla Sanchez Adams, and I'm a managing attorney at Texas Rio Grande Legal Aid, or TRALA. As the leading provider of free legal aid in Texas and the second largest legal aid in the country, TRALA serves nearly 25,000 people annually. TRALA serves the largest geographic area of any legal aid in the U.S., covering some of the poorest counties in the nation. More than 2.7 million residents of Southwest Texas are considered eligible for our services. The COVID-19 pandemic triggered a health crisis and a simultaneous economic crisis. Prior to the pandemic, systemic inequalities and disenfranchisement already existed among marginalized social groups such as minorities, women, individuals with disabilities, survivors of domestic abuse, and immigrants. TRALA's clients all belong to one or more of these social groups, and we found that COVID-19 exacerbated these pre-existing inequalities. In my written testimony, I addressed 3 harms faced by our client population during the pandemic. 1, the rise of debt collection activity. 2, the impact of credit reporting on debt and poverty. And 3, the failure to protect consumers from fraud. In my oral testimony, I will focus on 2 key points. First, we've observed how credit reporting has left many vulnerable Texans prone to future disenfranchisement and poverty. Although there are many problematic types of debt found in consumers' credit reports, I want to highlight the problem of coerced debt. Each year, approximately 800,000 women in the U.S. are physically assaulted by an intimate partner. 1 in 4 women will have experienced some form of intimate partner violence in their lifetime. During the pandemic, domestic violence has increased, and many survivors find themselves without any available options to relocate and leave abusers. In addition to physical violence, survivors are subject to other forms of abuse, including economic abuse. In fact, it's estimated that 94 to 99% of domestic violence survivors experience economic abuse. While economic abuse spans a wide array of tactics, damage to credit is of particular importance. Abusive partners damage credit by fraudulently opening accounts in the survivor's name, lying about paying bills in the survivor's name, overcharging credit accounts, or coercing survivors to sign for loans, credit lines, or other expenses. This type of activity is known as coerced debt. Coerced debt encompasses all non-consensual credit-related transactions, and although the term is most used in the context of intimate partner violence, it exists in other contexts such as elder and child abuse. The appearance of coerced debt on a consumer report is so destructive because credit reporting permeates almost every aspect of a consumer's financial life and can make or break the financial security of an individual. Consumer reports and credit scores are used by potential creditors, landlords, employers, telecom and utility companies, and even the government. As a result, coerced debt ultimately impairs the survivor's ability to obtain the credit, job, or housing needed to stay safe. Traditional lenders become less accessible, and survivors are left to obtain credit from predatory sources such as payday lenders. These high-cost loans aggravate an already desperate financial situation, trapping survivors in insurmountable debt. Without economic security, domestic violence survivors cannot have physical security. Coerced debt is best understood in 2 buckets: fraudulent or coercive debt. Fraudulent debt fits the basic understanding of identity theft. The coerced debt victim didn't know about the account or charges, didn't authorize the opening of the account or the use of an existing account, and didn't benefit from the debt. On the other hand, coercive debt is incurred by force or threat of continued violence or other forms of abuse. The victim doesn't really consent to the debt, but opens a new account or allows the use of an existing account out of fear of the repercussions of saying no to the abuser. Currently, only coerced debt victims who fit neatly into the bucket of fraud have avenues for relief. However, the vast majority of coerced debt victims in the coercive bucket have no remedies. Texas addressed this problem by amending our definition of identity theft to include coercion, but coerced debt victims from everywhere else in the country don't have the solution and need help. Secondly, we've seen an increase in aggressive collection activities. The number of default judgments obtained in 2020 increased despite a moratorium. Lenders were quick to repossess vehicles when consumers were unable to make timely payments on auto loans, and based on our observations, refused to work out payment plans or forbearance options. Simultaneously, we saw debt collectors more aggressively pursue post-judgment collection like bank garnishments. These collection methods led to seizure of economic impact payments, and because not all EIPs were or are protected from garnishment, collectors have taken advantage of consumers in already vulnerable circumstances and diminished the important work of Congress in providing much needed relief. I yield my time back. Thank you.
Thank you, Ms. Sanchez Adams. Now we'd like to recognize Ms. Schultz Wilson for 5 minutes for her testimony.
Good morning. First, I'd like to thank Chairwoman Waters and Subcommittee Chair Perlmutter and Ranking Member Meyer, for inviting me here today to testify on behalf of the low-income and low-wealth consumers that I have served for over the past 30 years. I come before you today to provide a face behind the statistics and the data on the economic toll of COVID-19 on these communities. During my career, I've had the privilege to lead several nonprofit organizations, some small with $500,000 operating budgets, some large with $50 million operating budgets, but with one goal in mind, and that's always to serve the community. I have been CEO of organizations such as the Connecticut Food Bank and of the Urban League of Southern Connecticut. It's at the Urban League where we provided much needed services to consumers, which included first-time homebuyer education, credit repair, financial education, foreclosure prevention, loan modification, and student loan services. My vocation and my passion and commitment revolve around empowerment. I have devoted my life to these endeavors and will continue to do this work. It is important that we all in the nonprofit community continue to stand in the breach to help consumers. The economic devastation that has impacted small business owners, including sole proprietorships in the Black and Latino community, continues to disenfranchise these groups. As heartbreaking as these scenarios are, many consumers are forced to use title loan companies, payday lenders, and other predatory lending businesses just to make ends meet. Rather than allowing borrowers to speak with someone to address these issues, many institutions are now forcing consumers to use computers. They're forcing them to go to their websites, and this includes mortgage companies, student loan companies, and auto finance companies. Many of our consumers have lost their internet. Many did not have computers to begin with, and if they did, some of them have been forced to sell their computers or to pawn them. We know that that's a business that's booming today, which eliminates their ability to communicate with financial services institutions. In addition, bank fees and overdrafts have plagued low-income consumers, causing many to lose their traditional bank accounts and to become unbanked, and force them to rely on check cashing establishments that charge predatory fees to the detriment of our consumers. That charge predatory fees to the detriment of consumers. Credit card companies monitor credit reports and raise interest rates based on credit usage. Late payments and missed payments generate even additional fees that folks from low income and low wealth communities cannot afford. Many of them are having to choose between feeding their families and providing essential basic services for their families. In Connecticut, I serve on the board of the Community Foundation for Greater New Haven, which has launched a $26 million initiative called Stepping Forward, a program which has set aside money to provide low-interest loans and grants to Black, Latino, and women-owned businesses impacted by the pandemic. It is also providing capacity building grants and operational support to the nonprofit community who are in the trenches doing this work every day to ensure economic empowerment and stability. Nonprofit organizations like the foundation stand in the breach and provide a safety net to many consumers who may not be eligible for traditional financial services. Recently, JP Morgan Chase announced that it would pledge $30 billion to close the racial wealth gap in Black and Latino communities over the next 5 years by funding organizations such as CDFIs, Black-owned banks, and providing down payment assistance for people of color. I'm very pleased that they have decided to launch this initiative. However, if credit restrictions are not relaxed, many of our low-income and low-wealth consumers will not be able to take advantage of this program, and the wealth gap will remain. In closing, low-income and low-wealth consumers need help. We need policies now that will allow businesses and consumers to be resurrected and made economically viable for the future. We need policies now that address structural barriers to resources, financing, and capital. Thank you so much for your time today, and I look forward to addressing your questions.
Ms. Schultz-Wilson, thank you for your testimony. Mr. Griffith, you are now recognized for 5 minutes for your testimony.
And thank you, Chairman Perlmutter and Ranking Member Meyer and other members of the subcommittee for the opportunity to testify today. My name is Joel Gerpeth. I am a research fellow at the Heritage Foundation. Are Americans slipping through the cracks in our economy? That is a very important question. Without a doubt, many are still suffering from the historic plunge in economic output that was triggered by the widespread shutdowns imposed last March. For the first time in our nation's history, governments across the country intentionally suppressed the supply of goods and services and artificially suppressed consumer demand. Within months of these shutdowns, more than 20 million jobs were lost. In April 2020, the US unemployment rate was nearly 15%, a full 4 percentage points above the previous post-World War II highs. Of course, the partial reopening of the economy did spur a robust recovery. Economic growth in the third quarter smashed all prior records, growing at a 33% annual pace. But this highest economic rebound this summer, the highest in history, proves that those who are properly informed of the actual risks of COVID and of the appropriate mitigation measures are enthusiastically participating in the reopening, going back to work, and going back to their lives. Financial conditions for most consumers actually show marked improvement compared to pre-pandemic. We have an increase in overall credit scores, and that reflects this surprising reality. Over the past year, delinquency rate on consumer loans actually plunged. In fact, delinquency rates now are the lowest in more than 30 years. Auto delinquencies in quarter 3 of 2020 were substantially lower than the year before, dropping by nearly 1/3. Mortgage delinquencies as well are holding up relatively well through the crisis. They've edged up slightly by 0.4 percentage points. Contrast this to the Great Recession, when mortgage delinquencies nearly quadrupled, soaring to 12%. Rental delinquencies also appear to not have substantially increased. The Census Bureau Household Pulse survey indicates that 21% of renters did fail to pay rent in December, but this is up just slightly from the 18% reported in March of 2020. National Multifamily Housing Council data confirms this trend. We have an elevated savings rate, hit an all-time high in April 2020. This helped drive down the amount of credit card debt outstanding to under 4.5% of disposable income. By the middle of last year, this was down sharply from the 8% rates that we saw during the Great Recession more than 10 years ago. Overall, the data are encouraging that consumers are more financially secure now than before the pandemic began. However, it is very important that we compare this national financial data to state-specific unemployment economic output data. We know that nearly 10 million people that have lost their jobs during the pandemic still are without work. The economic misery from these shutdowns is concentrated geographically in those regions affected by continued onerous restrictions such as curfews, capacity limitations, and distancing guidelines, and full business closures in states like California. The Federal Reserve State Coincident Index shows the approximate GDP by state, and it actually shows that in 8 states, the economy now is bigger than it was before the pandemic. These are states that are reopened, like Utah and Georgia. Contrast this with the deep recession that lingers in Hawaii, Michigan, Rhode Island, Massachusetts, and New York, many of which have economies that are nearly 10% smaller now than they were a year ago. In December, the 10 states with the fewest restrictions in place are averaging just 4.7% unemployment. Meanwhile, Los Angeles suffers from 10% unemployment, New York City above 8%, and El Centro, California, unemployment is near 20%. These economies are shut down. Compare that with unemployment in numerous towns and cities in Alabama, Idaho, Nebraska, and Utah, where unemployment is actually under 3%. Politicians in states and local governments who continue to advocate for shutdowns and economic restrictions are pushing millions of those who are unemployed or financially underwater off an economic cliff. And meanwhile, they're telling the public that these individuals are merely slipping through the cracks. Unfortunately, some are now using the persistent economic troubles in parts of the nation to push through a wish list of harmful credit policies. This includes suspending capitalization of interest and debt collection and repossession, along with suppression of accurate predictive credit reporting. Policymakers need to consider the unintended consequences of these actions, which will result in less available credit for both consumers and businesses, often to those who most need it. In summary, the financial condition for many families has improved over the past year, but restrictions that are still in place in some state and local governments on basic economic activity continues to hold millions of individuals from gainful employment and financial health. Using the economic misery that persists across portions of the nation as an excuse to advance a wish list of extreme proposals will suppress future economic growth. Congress should instead focus on better positioning our nation to lead in the use of finance through a more efficient regulatory code, free trade, and the competitive business environment. Thank you.
Thank you, Mr. Griffith. Thanks to all of our panelists for their testimony. I'm going to go vote. I'm going to turn over the chair to Mr. Caston, and I'm also going to recognize him for 5 minutes for his questions of this panel. Thank you.
Thank you so much, Chair Perlmutter, and thanks to all who have hopped in the seniority as Ed and I try to shuffle through the voting pattern here. Mr. James, I want to brainstorm with you a little bit, and this is an idea without legislation, so I'm not. None of these are intended to be leading questions, but it strikes me that there's as we've gone through and passed these really important and necessary eviction moratoriums, there's two parties to that. There's of course the tenants who have not been evicted and have not been financially squeezed. And then there's the landlords who are trying to figure out how to make sure that they can stay current on their mortgage payments. And I wonder if you have any data, because on the one hand, in talking with some of the, particularly the low and moderate property owners in my district, a lot of them have said that among their tenants, when they miss a payment, they can come current and stay current again, but oftentimes these folks don't have the income to ever catch up on all the back rent. So their credit score has permanently struggled. And on the other hand, for the landlords, they're always carrying this bad debt expense, because if you've got someone who's staying current on their payments but not catching up on the back end, you're carrying some asset on your books that everybody knows needs to be partially written off. My question for you, my first set of questions, is that for tenants who fall behind, do you have any data on what portion, even before COVID, what portion never catch up, and how does that vary between low and moderate and higher income tenants? Have you ever seen that analysis?
Thank you for your question, Congressman. I don't have any data on that specific issue, but I can respond and just agree with you that it is a very vexing question, because our institution, Carver State Bank in Savannah, Georgia, we actually see both sides of this, because a lot of our retail customers are the tenants who reside in some of these low to moderate income residences. But then a lot of our borrowers, one of the specialties that we have is actually lending to small landlords who own, 1, 2, 3, 4 units of property that they rent out to LMI communities. So we kind of refer to that as sort of naturally occurring affordable housing. And we have seen a surprising, we've been surprised that more of our landlords have not fallen behind. We did extend very generous forbearances at the beginning of the pandemic to all of our borrowers across the board to make sure that people did not have cash flow shocks. We've been able to find that our past dues have been reasonably strong. We haven't seen a lot of impact. I think that's because many of the lower income tenants, moderate income tenants, have been able to access, local programs in our community to help them to keep up with their rents. So I don't have sort of universal data on the question, but we would certainly be happy at the NBA to explore this issue further, because we do recognize it across not just in my bank in Savannah, but across our membership. We do recognize that there's a potential for this to be a really serious problem.
Well, I would love to see some data, and I want to let some of the folks who who spend their time exclusively on the consumer side of this to weigh in. Ms. Sanchez-Adams, I don't know if you have any thoughts, but what strikes me is in some sort of completely ideal policy mode, if we were to say that that the federal government would provide X% of back rent if landlords agreed to write off the balance, and I don't know what X is, right? But there's some number there where we protect tenants' credit score and we enhance the borrowing position of those landlords, because when you go out to write the mortgage, you're sitting there saying, yeah, I know you've got these assets, but not there. And if you've got any analysis of where that is, I'd love to see it. Maybe we can follow up after the hearing. Ms. Sanchez-Adams, with the little time I have left, do you have any thoughts on that question?
Sure. So on the one hand, if low-income tenants are living in public housing, they do have a portion of their rent that's being paid by housing authorities. And so those tenants aren't necessarily falling behind on their payments. They have steady income from public benefits and things like that. So that's not the case there. It's more the middle income that don't have public benefits that maybe have seen reduced income cut. The last thing that I will say, though, is that the credit reporting is easy to fix if you just put a moratorium on reporting of it for this certain period. That might be able to alleviate some of what you're talking about.
Okay, well, like I said, this is brainstorming. I don't have a specific policy, but would love to work with you. And I am out of time now, and I'll now recognize my friend, Mr. Barr, for 5 minutes.
Thank you, Mr. Chairman. I appreciate that. We recently held a hearing in the Oversight and Investigation Subcommittee examining portions of the population who are being left behind by the banking system. And during that hearing, one witness highlighted the problem of credit and visibility, where individuals have no credit record and the 3 nationwide credit reporting agencies don't really have any information about these people. Credit and visibility disproportionately impacts consumers in rural areas and can perpetuate the cycle of reduced access to traditional financial services. Mr. Griffith, how would you recommend that we address the problem of credit and visibility, especially in underserved communities?
Thank you for your question. Yeah, this is definitely a problem where there are a significant number of people that either have insufficient credit to have a credit score, or they actually have no credit lines at all. But what we see are that we have a number of institutions, including the credit bureaus such as Experian, that are making it possible for people to begin adding alternative credit lines, such as their housing payments, cell phone bills, other non-traditional types of credit. And this is beginning to being factored into some of these scores. So the private sector recognizes this as a problem. In fact, they have an interest as well in reaching an expanded marketplace, because many of these individuals are people that are financially responsible. It's just they don't have a credit score associated with their name. I think my fear is that policymakers would use this as a reason to put mandates in place, not recognizing all of the requirements that are incurred when you actually have somebody reporting data to the credit bureaus. There's a time expense. There's a legal liability as well. And we see a significant progress being made right now in the private sector.
Yeah, I agree with you, Mr. Griffith. I think innovation, especially in fintech with alternative data, is a way in which the private sector, without any government intervention, has provided greater access to credit for underserved individuals. One other question related to that, Mr. Griffith: how might nationalization of credit reporting, as someone on the other side have suggested, adversely affect underserved individuals' ability to gain access to financial services?
Yeah, well, a nationalization of this in terms of requiring credit companies to not report certain incidents of bad credit, that will actually impact those that are trying to develop their credit. It will impact them most adversely. And that's because you're going to require institutions, whether it's your automobile company, whether it's an appliance company, wherever you're looking at to get that credit, you're going to be requiring them to fly really in the dark. And so their risk is going to be elevated. They're going to either have to exclude more people even from the universe of people that they'll lend to, or they're going to have to adjust interest rates upward, not just for those who are higher risk, but for those actually who are paying their bills on time, because the credit agencies will no longer have access to that information, have the ability to provide it.
Yeah, one of the things I'm worried about is policymakers using the pandemic as an excuse to eliminate risk-based pricing, and lenders and other financial market participants really rely on risk-based pricing for their products and services. They use the best and most complete information available to assess the creditworthiness of the borrower and his or her ability to repay. And mispricing risk could lead to negative terms for customers and ultimately undermine their financial stability. Mr. Griffith, a final question: what impact would a government-imposed prohibition on risk-based pricing have on the price, availability, or access to financial services? And relatedly, do you believe that suppressing one's credit data could ultimately cause undue hardships for consumers?
Yes, the unintended consequences are very severe with this. If you the ability to actually accurately report somebody's financial situation or how they perform during a time of economic stress, like we have certainly seen over this past year, you're going to diminish that availability. Those who have a very long established track record, who can prove their income, they're going to likely be fine. They'll be able to obtain that credit. But it's those people that actually need credit the most sometimes in periods of emergencies, is those individuals who are going to be most harmed because they won't be able to find the credit when they need it. They're going to have to pay higher interest rates for legitimate credit, or even worse, you're going to see a lot of people forced into that unlawful black market where they're going to see them pawning off belongings, or even use of a loan shark where their physical life might actually be in danger.
My time is basically expired, so I don't have time for another question, but one final comment on debt collection. You know, I worry that, again, policymakers will use the pandemic as an excuse to restrict legal debt collection. And of course, debt collection and remedies for lenders is key to providing access and create a willingness for lenders to actually extend credit. So I don't want to go there either. But with that, I yield back and appreciate the opportunity to participate in this hearing.
Thank you. The chair will now recognize Ms. Velasquez, who is also the chair of the House Committee on Small Business. Ms. Velasquez, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Before I start with my questions, I would like to respond to Mr. James, who raised the issue of the necessity to extend the PPP loans process beyond March 31st. So I am happy to report that Mr. Meyer and I reached an agreement, a deal last night on extending PPP for 2 months, and for new loans, an extra 30 days for SBA, and to go over pending applications until June 30th. So I want you to know that, and I want to thank Mr. Meyer for his cooperation. Ms. Harrington, one of the bills that we are discussing today is my bill, the Small Business Lending Fairness Act, which will prohibit the use of confessions of judgments in commercial lending transactions at the federal level. Can you explain the confessions of judgment practice and how it is often used to harm unsuspecting small business owners and borrowers?
Thank you. Absolutely. This is a really problematic practice and tool, and just another example of why we need more oversight. These are tools that are placed in contracts. Business owners have been forced to sign them, and it means they're basically agreeing in advance for a default judgment against themselves, and it really puts them in a very severe predicament. Then exposes them to so much harm later and so much financial constraints. And this is what we've seen. We saw it in New York, in your home state. We've seen this happen, and we've seen the economic strain it causes, the mental health strain it causes, and just how abusive and predatory this practice really is.
And can you explain, please, why this is something that we need to prohibit at the federal level and should not be left to the states, as some might argue?
Because it's basic principles of fairness and consumer protection, right? This is essentially contracting away your legitimate right, your legitimate defenses. And so we need to be protecting consumers as much as possible and creating a ceiling, right? And creating a floor for consumer protections at the federal level. And then states can go beyond that. But we want to make sure that consumers are as protected as possible, especially when we're seeing such predatory acts going on.
Thank you. And Ms. Harrington, as you know, TILA requires transparent disclosures for consumer loans, but not for small business loans. I have been working with Senator Menendez on legislation that will extend TILA to small business loan. How would the extension of the TILA statute to small business loan better protect small business borrowers and enable them to make fully informed comparisons on their financing options?
I think it would be really impactful. It would enable them to compare products, to know when they're being offered high cost predatory loans. But in addition to that, we should really be thinking about a federal rate cap, because that will protect consumers and small businesses and ensure that they have the best protections. TILA is great, and TILA for small businesses will be wonderful, but we need a rate cap. We need to be protecting them as much as possible.
And can you please explain how transparent and standardized pricing are particularly important to small business owners during this time of COVID, particularly those that are women and minority owned?
So businesses owned by women and people of color are actually more likely to rely on online lenders. They've traditionally been shut out of the traditional credit market in many ways, and we saw that play out, especially during the first round of the Paycheck Protection program. And so because they've been more likely to use online lenders, these fintech lenders that use excessive pricing models, they are more at risk of being subjected to these higher cost products. And so they definitely need that protection so that they are able to fully evaluate, but they also need real access to affordable, safe credit products. And more banks need to be in the business of serving all small businesses.
Thank you. Mr. Chairman, I yield back. Thank you.
Thank you. The chair now recognizes Mr. Posey from Florida for 5 minutes.
Well, I thank the chair and the ranking member for holding this hearing. Many of us believe our financial institutions and markets are the envy of the world. Over a long and innovative history, they have evolved to process information, reflect that information in prices, and send those price signals to lenders and borrowers to provide gains from trade to both parties. Borrowers, as well as lenders, benefit from markets based on good information. To jeopardize these informative functions would risk creating a market for lemons where good credit risk could not be distinguished from bad credit risk. The result would be a market where credit access is difficult and expensive for everybody. Today, with the rush in the House to reinvent all our best institutions, I'm reminded of a variation of an old joke. When a constituent comes to a congressman and asks, who was it that invented progressivism? Was it the politicians or scientists? The congressman replied, why, the politicians, of course. The constituent responds, well, that explains it. Scientists have tried it on mice first, or would have tried it on mice first. Our first duty is to avoid adverse and unintended consequences. We can't try out these proposals in a lab. We have to rely on principle and common sense. And so, Mr. Griffiths, could you please describe how our financial markets would be affected by imposing restrictions on credit reporting?
Yeah, thank you, Congressman, for your question. When you impose restrictions on credit reporting, what you're really doing is you're forcing lenders to fly blind. You're disabling their ability to actually judge risk based on somebody's past decisions, but also the circumstances they find themselves in. And I understand that the intentions are good because we want the people to have access to the credit necessary to fund their dreams. But what you're in effect doing is you're increasing the risk that's involved in making those lending decisions, because now a company is not actually able to model what the risk is in making a loan to an individual. The less information that a company has to make a decision for anything in business, especially when it comes to lending, the less information that they have, the more likely that they're going to either choose not to actually provide the loan, or they're going to have to increase the interest rate on that loan or on loans they make to others to compensate themselves for that increased risk. So you'll end up seeing a number of people priced out of the marketplace or not have access at all. And then the worst case scenario is you end up with individuals that have to pawn off their possessions or seek financing on the black market where the rules to protect them don't apply at all.
Well, thank you. What are the effects of eviction restrictions that are imposed for too long periods of time?
Well, thank you for that question. We've seen eviction moratoriums, of course, on the national level, state and local level through this period. And what's very interesting, as I mentioned in my testimony, we actually see rental payments only up slightly over the past year. So what you've seen is you've seen a lot of folks that aren't paying the rent. They know they can't be evicted. even if the eviction moratoriums are lifted in the near future, much of that revenue that was not paid to the landlords, that's not going to be returned. That's just going to be an expense, and that the landlord's going to have to eat. It's going to harm the business, but that's going to have an impact beyond just the landlords. You're going to see with this knowledge that these moratoriums might be imposed, you're going to see lenders once again have to tighten up their risk parameters as well. They might have to charge extra for security deposits. There might be instances in which they choose not to rent someone for whom the credit score might not be high enough. And of course, the government could try to work around that as well and force them to make to rent out those properties. But then you're going to have to see landlords keep more money on retention, because they're going to have to still pay for repairs, upkeep, taxes, and their own mortgage payments. So the repercussions are still going to be not just on the landlords, but be on those that are looking for a place to rent as well. And often those are going to be those who are most in need of a rental place because they can't yet buy a home.
What would you change about the CARES Act provisions that targeted pandemic relief for credit reporting and mortgage forbearance and evictions?
When it comes to these eviction moratoriums, any of these really should have been done on a state and local level and only used very sparingly. The ability to actually possess your own private property and enforce the contractual arrangements that you have, that underpins our entire economic system. It's made us the most prosperous economy in the history of mankind. When you start eroding those property rights and the ability to actually enforce your contract, you're decimating private property in general.
Thank you.
Gentlemen's time has expired. Mr. Posey yields back. I'd like to thank Mr. Kasten for covering for me. And I'd now like to recognize the chairwoman of the full committee, Chairwoman Waters.
Thank you very much, Mr. Perlmutter, for the time. I'd like to direct this question to Robert James, President of Carver Development CDE and Chairman of the National Bankers Association. As you know, before Yellen left, the feds, she placed a cap on the assets of Wells Fargo. Wells Fargo indicated they wanted to do PPP, but because of the cap, they would not be able to do it. And so there was an agreement made that he would be able to do PPP if, in fact, he would contribute to CDFIs and MDIs, all who need capital. We've been working hard for years to do everything that we can to increase the capital for our banks, minority banks, and for our CDFIs. And so what I want to know is, have Wells Fargo and other banks who said they were going to follow suit and they were going to make the PPP funds that they had earned because of their work, that they were doing with distribution of PPP available to the MDIs and the CDFIs. We don't know if they're followed through. And I just talked with one of our staffers who indicated that they are trying to track it also. But have you had any experience? Do you know whether or not our MDIs and CDFIs have been receiving donations, contributions from either Wells Fargo or any of the other banks who claimed that they were going to do it?
Thank you, Chairwoman Waters, for that great question. We do know that Wells, as well as a handful of the large financial institutions, in addition to them, just a handful, have been making some capital equity investments in some of the MDI banks. I'm not sure if those funds were previously earmarked or if they were the funds that are coming from their PPP fees. And I am familiar with the commitment that you referenced. But I do know that some of the capital investments have started to flow into our banks. But of course, those are transactions where we're selling, our banks are selling a security to Wells or some of the other large institutions. So they're receiving a preferred stock investment. Sometimes it's common, but they are receiving a security in exchange for that. There's not been an enormous amount of just grant activity from the large institutions into the MDI sector.
Okay. Yeah,
So-
that's different. That's different because, you have a term sheet that you've got to negotiate. And sometimes, we worry about what they're asking. So, and I'm hopeful that those who are negotiating that kind of investment will be very careful to protect the ownership of our minority banks. But here's what I want to ask also on Wells Fargo. They are touting a down payment assistance program. Have you seen any or heard about any of the beneficiaries being contacted, being worked with, rather?
Chairwoman Waters, I'm not specifically familiar with that program, so I can't speak on it one way or the other as to whether it's occurring.
Would you do me a favor, as the chairman of the National Bankers Association? Could you make inquiries of the bankers in the National Bankers Association to find out who are the recipients of contributions, donations from Wells Fargo and others, and whether it's like you are indicating here today, all of the relationships, basically, as you understand it, are transactional relationships where there are equity investments?
Chairwoman Waters, we will absolutely get that information to you and your staff as soon as possible. Thank you.
I'd appreciate that, because we intend to follow up. Oftentimes, we have the banks that indicate they have programs that are assisting MDIs and CDFIs, but we never really understand what they've done, how much they've done. We've never done a good job of following it. And this time, I'm going to actually engage in that effort so that we can know whether or not they're living up to what they're representing, so that we can deal with it. So thank you so much for being here today and for agreeing to do some follow through on this.
Absolutely, and thank you for your continued support. We appreciate it.
You're so welcome. I yield back the balance of my time, Mr. Perlmutter.
Thank you. The gentlelady yields back. The ranking member, the gentleman from Missouri, Mr. Lukemeyer, is recognized for 5 minutes.
Thank you, Mr. Chairman. And I just wanted to open with a statement with regards to the PPP program. I know several of the witnesses referenced this, and I know that Chairman Velasquez, the Small Business Committee, which I am the ranking member of as well, and I had an agreement last night, and the bill was dropped, I think, late last night or this morning to extend the PPP program. I want to extend my congratulations and thankfulness to her for her help and willingness to work on a bipartisan fashion on that issue. And we look forward to that bill's passage on a bipartisan basis as well. As we go through getting everybody back up to speed here, one of the things that's concerning to me has been the lockdowns. My state didn't, we came basically out of the lockdown back in mid-May, and we had a 5% increase in revenues from 20 over 19. I live close to Lake of the Ozarks, one of the greatest recreation areas in the middle of the country there. We had double visitation in 20 over 19, which was, and 19 was second highest visitation year in history for the lake. So it's huge economic activity that can come back after the lockdowns. And so to me, the biggest deal coming back for our economy is to get everybody out of the lockdown, get everybody vaccinated and off and running. Mr. Griffith, I just would like to ask you your perspective on that comment.
Oh, you're absolutely right. Thank you for that question. Yeah, what you see across the country right now is really almost a tale of two different economies. I visited New York City multiple times over the past year during the lockdowns, and it's just so sad when you see entire blocks of not just businesses that are temporarily closed, but they're done for good. And then visiting family and friends in Florida and Georgia, it's a different universe. You've got restaurants that are many restaurants and bars in New York City, for instance, and establishments that are shut down forever and have relocated to Florida because they can actually run those businesses. And of course, the tax structure is better. Same thing goes with California. You look at California compared to Utah, California compared to any other or Texas.
Okay, you're fading out on me here, Mr. Griffith. Let me ask another question very quickly as soon as you get back up and running here. Mr. James, I appreciate your testimony this morning. One of the things that we've talked about throughout this pandemic, it's something I've been pushing for a long time, has been forbearance by the regulators with regards to enabling banks and credit unions and people in the financial service industry as a whole to be able to give time to their customers to be able to get back on their feet. I think the quick rebound that we've seen so far, and I think you can anticipate coming shortly, would indicate that people can get back, businesses can get back to a new normal, which would be similar to what it was the previous 3 years to the pandemic. And so, my question to you is, in the CARES Act and in the bill at the end of the year, we had an extension of troubled debt restructuring rule as well as CECL. How important do you think the continuation of those forbearance tools or forbearance on those regulations is going to be in the coming months and years here?
Ranking Member Lukemeyer, thank you for the question. We actually are very much in agreement with any kinds of assistance that we can get from our regulatory partners, and we're grateful for Congress including those provisions in the recent relief packages. It's of critical importance that our institutions are not forced to declare troubled debt, and that we have time to work with our customers to allow them back. Most of our banks in the MDI community experienced this in the last economic slowdown in 2008 and 2009, where we were forced to write down certain credit, even in the event that we knew that the borrower was going to be able to recover. And so we're grateful for Congress including that, grateful for your advocacy on that point. And we welcome the continuation of those, the easing of those regulations so that we can work with our customers.
Thank you for that response, because I think that's extremely important to be able to allow people and businesses time to work through this. I think we can actually get back on our feet very quickly if we don't become real punitive from the regulatory side. So thank you for that. Going back to Mr. Griffith and talking again about getting our country back on track, it would seem to me that what showed in the 3 years prior to the pandemic was low taxes and minimal regulation really inspired and enabled and empowered the businesses and people to be able to drive our economy. How important do you think it's going to be, Mr. Griffith, to continue that low tax, minimal regulatory regime to be able to make it?
Time is hit there, but if we want to go back and see median household income hit new all-time highs and see record low unemployment across the entire nation, we do need to keep the eye on the ball there, and that's knowing what works and continuing with those advances.
Thank you very much.
Thank you. Gentlemen's time has expired. Thank you very much. I'd remind everybody, if you're not speaking, please make sure you're muted so that we don't have feedback. Now I'd like to recognize the gentleman from California, Mr. Sherman.
Thank you, Mr. Chair, and congratulations on your first hearing of one of the most important subcommittees in the House of Representatives. Glass-Steagall was the law of this country for a long time. With Gramm-Leach-Bliley, we at least allowed financial institutions in one part of the financial world to be allied with those in another, so that your credit union could also sell you insurance. But the basic rule there was that we drew a line between financial services on the one side and the rest of commerce on the other. There was, however, one vestigial exception to this. It was not part of any overall plan reached in the latter part of the last century. It went back well over 100 years, and that is the industrial loan company. Ms. Harrington, just over a week ago, it was reported that Walmart had hired Goldman Sachs as head of consumer banking, announced a partnership with Rabbit Capital in an apparent attempt to expand itself into the financial services world. Walmart and other major retailers have, at one time or another, sought state-issued industrial loan company, ILC charters, to break that wall between commerce on the one hand and banking and financial services on the other. On December 15, 2020, just as the last administration was leaving, the FDIC adopted rules that paved the way for non-banks to own ILC chartered banks without being subject to the same oversight requirements. Do you see this as a problem for consumers and taxpayers when it looks like Walmart can get involved in financial services and not be subject to the same rules?
Absolutely, and I'm so glad that you raised this question, Congressman. This is something that we have been advocating about for a while. We really urge Congress to impose a moratorium and close that loophole. This is really concerning. There are 6 ILC applications pending right now, and we saw what would happen with ILCs in the last recession. Actually, there was a major meltdown from that. They pose a lot of systemic risk, consumer protection concerns. We all should be worried about these companies and these pending applications, and we urge you to impose that moratorium.
Well, hopefully the new FDIC will take a look at the moratorium that had been imposed for many years and reevaluate this last minute change of policy in December of last year. Mr. James, I was a strong advocate for the extension of Section 4013 of the CARES Act, which allows banks to modify certain loans, work with the borrower, restructure, whether it be a consumer loan or a commercial loan, without that debt being classified as a troubled debt restructuring and hitting the bank's capital. But we have this unusual end date for this program where it's supposed to end at the end of this year or 60 days after there's a declaration, an end of the declaration of national emergency, and we don't know when that is. So, but banks are trying to decide what to do and do their business planning without having a definite date. Wouldn't it be easier to plan if you knew that this special provision was going to expire on December 31 rather than December 31 or maybe just a chance early?
Thank you, Congressman. Again, we would very much appreciate some certainty on that particular issue. And quite frankly, in the MDI community, what we've experienced is that oftentimes our borrowers, the shock happens a little bit later. People will make payments, will stay current, and then it'll happen, a year from now, later. And what we need is to be able to just work with our customers. We know our customers, we're on the ground, and we think that we can manage that risk the best from the grassroots perspective. And so we appreciate the suggestion in your question, and as well as in our ranking member Luetkemeier's question. Just very quickly on the ILC issue, as heavily regulated institutions, we certainly invite all financial services providers to be subject to the same regulatory partnerships that our institutions are subject to. And so we welcome the committee's actions on those in that regard as well.
If your answer, yield back.
Gentleman's time has expired. The gentleman from Oklahoma, Mr. Lucas, is recognized for 5 minutes.
Thank you, Mr. Chairman, and I too congratulate you on this challenge that you've taken on for the next 2 years. And I also was very impressed with the line of questioning from the full committee chairman about what she personally expected. I'm sure that'll be a topic of discussion later at some point. But for the moment, let's cut back to the fundamental issues at hand here. Congress has leaned on the strength of the banking system throughout the COVID-19 pandemic. We gave financial institutions enormous tasks of delivering billions of dollars to support small businesses all over the country. Banks have also offered avenues to help individuals and businesses affected by the pandemic, deferred payments, waiving fees, all sorts of modifications. Mr. Griffin, how can Congress ensure that financial institutions continue to have flexibility to meet their customers' needs during the pandemic?
Yeah, thank you for that question, Congressman. Well, I think it goes to allowing the private sector to actually innovate. There was some discussion just a second ago, for instance, about Walmart's efforts to provide banking services at its locations. And of course, we've got competing interests, some interests that don't want another competitor entering the marketplace. Well, in this situation, if we want to actually reach more of those who are unbanked, it seems to make a lot of sense that there would be an institution with thousands of additional locations being able to access those individuals. That's one way. Second of all, Congress can refuse to actually interject themselves in the systems that already are set up between merchants, between customers, and between other banks. We saw several years ago caps that were placed on debit card transaction fees, for instance. And I understand, once again, the intentions may have been good to help consumers, but what did that result with? Well, that resulted in a giant shift of wealth from small retailers to big retailers. And it also resulted in many consumers who are middle class and lower middle class no longer having access to free checking accounts, because every time they'd swipe that card through, a lot of those fees would go to actually provide basic services to them, such as no fee checking accounts. So we actually hurt the very people we are intending to help. And right now, the financial sector is innovating tremendously. Just think about all these new apps that we use to go back and forth between people, such as Venmo and PayPal. This is innovation that is occurring organically on its own because there's a desire on the part of businesses to meet the needs of consumers. Both sides win. The businesses, the providers make money, and the consumers win because it makes our lives easier and oftentimes less expensive. The worst thing that we can do is to implement bad policy with the best of intentions, because you end up hurting the people you're trying to help.
Mr. Griffin, the next point I'm going to bring up, many people might consider to be a paradox or something ironic. But you and I both know in economics, there's a reason for everything. So could you further discuss why, as COVID-19, the pandemic has so severely damaged the U.S. economy, the average American's credit score actually improved? Some would call that a paradox, but there's a reason. Can you discuss that for a moment?
Yeah, thank you, Congressman. Yes, we saw credit scores actually increase over the past year. And that's for one big reason. And that's people ended up saving more of their money than they have at any time in our nation's history. The savings rate that briefly eclipsed 25% of income. And that was in large part because most people, thankfully, were able to retain their jobs, but unfortunately weren't able to actually engage in the marketplace. And instead of spending the money, they actually paid down debt or saved or invested. But another piece of this was we saw a lot of transfer payments in the form of enhanced unemployment benefits that paid people more off the job than on the job, and then also stimulus checks that went to most Americans indiscriminately, thousands of dollars in stimulus checks. And this is another thing, it's tough with politics. It makes maybe for good politics to give people free money. The problem is, of course, that we borrowed from future generations to do that, and people acted irresponsibly in their own way with that free money, but they're actually going to be paying for it for many, many years to come. And that explains a big chunk of why we actually saw credit scores increase. And we also saw the amount of credit card or disposable income used in credit card debt actually shrink dramatically over the past year.
Are you telling me, Mr. Griffin, nothing's ever free?
Nothing is ever free. In fact, we're already starting to pay for this. We see the uptick in inflation. We've seen economists on the left and right warn that this latest package that was passed could have very severe consequences in terms of our monetary system going forward. We will pay for this one way or the other, either through higher inflation or higher taxes or other consequences. We're going to pay for it at some point.
With that, I yield back to my good friend from Colorado, the chairman.
Thank you, Mr. Lucas. Mr. Green, gentleman from Texas, is recognized for 5 minutes.
Thank you, Mr. Chairman, and my compliments to you for the outstanding job you're doing, but it's what I expected, so thank you very much. I want to associate myself with the remarks of the chairwoman of the full committee. I enjoy hearing her make comments about the small banks, the minority banks, and I completely agree with her, which is a good segue into HR 1669, Mr. James. This is a piece of legislation that the chairwoman assigned to me, and I'm proud of the legislation. It has been made a part of the package, the rescue plan. And it deals indirectly with small banks, minority-owned banks, MDIs. I'm sure, Mr. James, that you are familiar with President Vignard and Chair of the Board, Lawal, with Unity Bank in Houston, Texas, which happens to be in my congressional district. Are you there, Mr. James?
I'm here. Yes, I'm very familiar. Thank you.
Well, I can tell you that President Vignard speaks highly of you. I'm appreciative that you're part of this hearing today. This bill would restart the State Small Business Credit Initiative And for our purposes today, let's just call it the Small Business Credit Initiative. And it accords $10 billion in getting this credit initiative regenerated. And it is expected that this would stimulate up to $100 billion, 10 billion, 100 billion. My concern is whether or not the intentionality that we had in mind when this bill was being crafted and hopefully would pass is going to actually be implemented, because the thought was that Treasury would make sure that these funds in implementing the program would be moved through CDFIs and MDIs. And we would like to see that you and other small depository institutions would have the opportunity to receive these funds and to work with them to make sure that they get to small businesses. One of the reasons that I'm so interested in seeing it work through this process is because you didn't get any PPP help. And I was one of the persons who pushed for PPP help for small banks. I thought that it could be done, but it wasn't. And I respect those who were not able to do what they probably wanted to do as well, but couldn't get done. So I have great respect for them and appreciate what they've done since that time. So the question to you is, do you think that Treasury should help us to get this money to the CDFIs and MDIs and then on to the small businesses that can benefit from the program?
Thank you for the question, Congressman Green, and thank you for your leadership. Just very quickly, Laurie Vignaud, president of Unity Bank, and Casey Wall, who is their chairman, are very active members of the NBA. Laurie is a great member of our board, and we're happy to have her service in leadership. Yes, to answer your question, we think it's very, very important that Small Business Credit Initiative funds are, at least in part, directed towards CDFIs and MDIs that are really closest to these small businesses. And again, it's a very common sense concept that you raised, Congressman Green, to make sure that the banks that are closest to the smallest businesses have access to a proven program to help them leverage funds to ensure that they can offer more credit to the businesses that need it the most. It makes an incredible amount of sense to marry CDFIs and MDIs that, again, have a mission to serve minority businesses, mission to serve rural communities, low-income borrowers, to marry those mission-driven banks and institutions with a program like the SBCI program that makes, that has the possibility of being leveraged up 10 times, as you so clearly articulated. And so, yes, we strongly support Treasury acting with intentionality to make sure that our institutions, our banks, as well as other CDFIs, have full access to the SBCI program and are able to get those resources into the hands of small borrowers in low-income communities.
Well, my time is about up, so let me simply thank you and the other MDIs for the outstanding work that you do in communities that, if not but for you, might not receive the kind of aid and assistance that they get from lending institutions. And I, of course, will yield back the balance of my time. Thank you so much, Mr. Chairman.
Gentleman from Texas yields back. The gentleman from Georgia, Mr. Loudermilk, is now recognized for 5 minutes.
All right, thank you, Mr. Chairman, and congratulations to you for your new position here. I've always enjoyed working with you, and I appreciate that you need me on this subcommittee as well.
So to the panelists, I say everybody's congratulating me because they never thought I'd make it this far.
Well, thank you, Mr. Chairman, and I've always enjoyed working with you, but I must admit I'm disappointed to see legislation in this hearing to eliminate the OCC's true lender rule. This is something that we worked on very hard in the previous Congresses to get done. And, the rule provides clarity that's so critical and important for the bank fintech partnerships, which have resulted in incredible advances in access to credit for consumers and businesses who have been unable to obtain a traditional bank loan. And it's odd that the majority is opposing another fintech provision, again, seeing that fintech companies have been by far the number one source of PPP loans to minority-owned businesses. The FDIC's new chief innovation officer recently said the best way of banking the underbanked is through technology. So instead of opposing fintech, I believe we, in a bipartisan way, should be embracing it and seeing how we can use it more effectively to help small businesses and individuals, especially those who are underbanked. But on another topic, our country has a credit-based economy. That means it's essential for lenders to evaluate borrowers' ability to repay loans, and it's also essential for lenders to be able to collect debts. Otherwise, no rational lender would blindly extend credit that may never be paid back, which would further hurt those who need access to credit the most. Mr. Griffith, as you know, removing important information from credit reports is a bad idea. Instead, Republicans, led by Ranking Member McHenry, have proposed legislation to make targeted reforms, such as removing paid medically necessary debt from credit reports after 1 year. Could you comment on that proposal?
Thank you, Congressman. Thank you for your question. And you're so right. When it comes to making these reforms in the credit system, we have to keep in mind what those negative and unintended consequences might be. We know that lenders, banking institutions in particular, the need to be able to make proper judgments when it comes to making risk assessments. This option that you've talked about is certainly far more targeted in its approach because it doesn't just eliminate all collections from off the report. It focuses in on those which were incurred through no fault of the customer's own, usually medically necessary procedures. But more importantly, it would only eliminate from that report those that have been fully repaid. So I think that's a substantial improvement over some of these other suggestions. I think it's important to note as well that oftentimes when it comes to getting a loan, lenders actually do take those provisions into account already. Even if it shows up as a medical lien on the credit report, lenders do have the option to take that into consideration, especially when it's been repaid. And we see a number of people that have been able to secure financing even with that on the report.
All right. Thank you. I grew up in a low to middle income family. My dad worked construction, started his own business when I was in high school. And I remember he was trying to expand the business. He had more work than he had employees or capital to actually expand his business. And he went to the bank and he came back. This was in the early 80s. And I asked him if he got the loan, and he said, no, I wasn't able to get the loan because basically you have to prove you don't need the loan to get a loan. And so the lenders are an intrinsic part of our economy, especially for those who don't have the resources. It's an equalizer, you may say, because if it wasn't for the lenders, only those that already have the resources would be able to conduct business. So if lenders, what incentive would lenders to have to make loans if they're unable to collect on those debts?
Yeah, and there's an important distinction that you've made between medically necessary paid debt and medical debt that hasn't been repaid. I think a lot of folks may not be familiar with how that process works. If you have an emergency medical procedure, if you have need for that, a hospital is required to give you that procedure, whether or not you have medical insurance, whether or not you're covered by any of the government programs. And they do that knowing that they can go ahead and collect later, and ultimately they can put that on your report, which is an encouragement for you to repay that loan. That's an incentive for people to try to be responsible, try to maintain health coverage, because if you know that you can have any medical procedure that you need and you might be billed for it, but it's never going to show up on your credit report, that's an incentive for some to actually go ahead and just move that responsibility for their health onto those around them, because it's not the hospital ultimately that's paying for that. It's everyone else in your community. So I think that legislation makes an important distinction.
All right, thank you. I yield back.
Gentleman yields back. The gentleman from California, Mr. Vargas, is recognized for, 5 minutes.
Thank you very much, Mr. Chairman. I hope you can hear me, and I want to add my congratulations to you two. I have to say that you even seem taller.
Okay, let's not go there, please.
And I have to say, my good friend from Oklahoma said that, we're, in a sense, there's no free lunch, that we're borrowing from future generations. I have to say, it rings sometimes a little hollow to me when I didn't hear the same speech when the Republicans that did their tax giveaway of about $1.9 trillion to the wealthiest Americans. And we were going to do that again on the backs of future generations, because that went right into the deficit and then it's going right into the debt. I didn't hear that same speech. It seems that that speech only comes along when Democrats are in charge. So it always rings a little bit hollow to me. I hate to say that, but that's the way it rings to me when you have the same issues, but there's a giveaway to the rich and no one says anything about that, and then you try to help out people that are poor or struggling. So, oh, that's going to come out of the future generations. I don't agree with that. But anyway, in a normal economy, when a borrower requests forbearance on a loan, it could be a sign of a borrower's inability to pay that loan moving forward. However, as we know, this is the pandemic, so a lot of people have asked for forbearance. And one of the bills that I have is the Protection Access to Credit for Home Buyers Act. It basically says that that when you're doing this, when my legislation promoted would prevent Fannie, Freddie, and FHA from treating mortgages differently, but solely on the basis of this forbearance because of the pandemic. So I'd like to ask Ms. Ashley Harrington, would you further explain why any penalties are imposed on borrowers for request of forbearance could be detrimental to equal access to home ownership, especially when it comes to this issue of right now during the pandemic?
Absolutely. So home ownership, first of all, remains so out of reach still for so many people of color. And so we need to be at this time protecting home ownership rates as much as possible and keeping people in their homes, both from an economic standpoint and from the public health standpoint, right? People being in their homes and being safe and having a safe place to go makes all of us safer and makes our economy better. And so if we don't prevent these negative consequences from happening, what we may see down the road is a foreclosure crisis. And what we're trying to avoid is that happening, because that has impacts that's very negative for not just individuals involved in their families, but that can have a ripple effect on the communities around them. So we want to be very careful to have as many protections in place as possible, and we need to be acting to have the private backed mortgages mirror what is happening with the federally backed mortgages as well, so that all borrowers can have some of those protections.
I agree. Thank you. Well, with respect to that, then what can Freddie, Fannie, and FHA do? What can they do to help to make sure that this doesn't happen?
Sorry, still to me, right, sir?
Yeah. So what can we do to make sure that this doesn't happen? I mean, we're the federal government. What can we do to make sure we don't have all these defaults? When we had them before, obviously it was devastating for people of color, especially African American community, Latino. What can we do? How are we going to do things differently this time so we don't get it wrong like we did last time?
So absolutely making sure that, one, we're doing the outreach and we're giving borrowers all the options. We were really glad to see in the American Rescue Plan that's about to be signed, the $10 billion homeowner assistance fund that is also going to be very helpful in keeping homeowners in their homes. We would love to see more of that type of support, because that is going to be pivotal when so many folks are reporting that they are behind, that they are worried about how they're going to pay their next mortgage payment and all of these other things, especially when we know that the low income, low wealth folks who do have homes are the ones who are disproportionately impacted by the job loss. And there are many jobs that aren't going to come back, small businesses that aren't going to come back. And so we need more relief and more support programs like that. And we need to make sure that homeowner assistance fund is distributed equitably, and that will fall to Treasury. We need to be watching to make sure that happens.
Thank you. Lastly, if I could just sneak it in, I'd like to ask Mr. James, I'm very concerned about potential default risk for people of color and the small loans that they've needed to survive this pandemic. What can we do? What should we be doing more than what we're doing already?
Very quickly, Congressman Vargas, thank you for the question. I think we should explore the creation of credit enhancements and opportunities for consumers to have some room for credit and partner with the banks so that we can continue to extend credit to consumers that really desperately need to purchase groceries or make rent. I think we can explore some ideas like that with your committee. Thank you.
Thank you.
Gentleman's time has expired. The gentleman from Tennessee, Mr. Rose, is recognized for 5 minutes.
Thank you, Chairman Perlmutter and Ranking Member Lukemeyer, for holding this hearing, and to our witnesses for being with us today. And Mr. Perlmutter, I'll join everyone else in congratulating you on your chairmanship and look forward to working with you on all that we do with this subcommittee. Throughout the pandemic, we have seen financial institutions make unprecedented accommodations for their consumers. Several weeks ago, I was meeting with a group of bankers back home in the 6th District of Tennessee, and they were detailing all of the ways that their institutions are helping their customers during the pandemic. And I think that this serves as yet another reminder that federal intervention should not be the automatic answer, even in times of crisis. I believe we need to be focused on economic recovery, and it is my concern that some of my colleagues on the other side of the aisle could be using the pandemic as an opportunity to restructure parts of our financial system by implementing long-time progressive policies that they've advocated. The HEROES Act put forward by House Democrats, which this committee discussed at length, went beyond provisions put forward in the CARES Act by suspending negative credit reporting during COVID-19, as well as any other future major disaster. I believe this has the potential to create barriers to accurate credit reporting. Mr. Griffith, in your testimony during your exchange with Mr. Lucas, you pointed out that during the pandemic, credit scores have actually been increasing, and that overall the financial situation of most consumers is far less precarious now than during the financial crisis of 2008. Mr. Griffith, would you discuss how barriers to accurate and complete reporting would actually decrease the predictive power of credit files, as well as jeopardize the availability of low-cost credit for some consumers?
Thank you, Congressman. Thank you for your question. Yeah, without a doubt, if you impede the ability of lenders to actually have an accurate snapshot of the people to whom they're intending to lend, there are going to be a few consequences from that. Either they're going to have to deny individuals credit that they otherwise would lend to, because those that may have been deemed a moderate credit risk, now they don't have a way of making that determination. Or they'll have to increase interest rates on those that they're making a loan to, and in some cases across the board to compensate themselves for that additional risk. You're forcing them to fly blind. When you have a lender or any institution that's loaning out money, that is their capital that they're lending out, and they need to have a reasonable assurance they can actually be repaid. When you blind them to the reality of whom they're lending to, you might be trying to help the borrower, but in effect, you're hurting both the lender and the borrower. And I think we need to be very careful as well when it comes to suspending these reporting requirements during this emergency or others. There's proposals now to suspend reporting on adverse credit issues during national emergencies. Well, there are hundreds of active national emergencies in any given year. And suspending reporting during any of those crises just by being able to say, oh, I was impacted by this, that's going to have severe consequences for credit markets long term. And we really need to keep in mind that those that are even that are restarting their credit or they're emerging from bankruptcy, they have options as well. We have a robust credit market. Those that are looking to get a vehicle or a home, even a year or two out of bankruptcy, have the option to do so. So we need to keep the focus on transparency and disclosure so that these lending companies can actually make risk-based, risk-informed decisions. It's a benefit to all of us.
Thank you. I want to shift gears a little. Another provision put forward in the HEROES Act was a government takeover of the student loan industry. HR 6800 would direct the Treasury to make payments of up to $10,000 per student for private student loan borrowers. I'm a big proponent of career and technical education programs, and back home, many of the students in my district make the decision to go into the trades, whether it be farming, welding, plumbing, or other necessary services. It concerns me that these taxpayers that didn't avail themselves of a college education, but in fact got trade training, who choose not to go into debt for a four-year degree, would be subsidizing, in effect, the education of others, when all of the data seems to show that college-educated employees earn more over a lifetime. Mr. Griffith, in your view, in the little limited time we have, is canceling student debt a good policy choice?
Student loan debt is regressive, it's inequitable, and it's ill-conceived. It's regressive because most Americans don't have a college education, and you're forcing them to pay for the education incurred by others. Really, this is a giveaway to the many levels of higher education administrators.
Thank you. I yield back. Thank you, Mr. Chair.
Thank you, Mr. Rose. You yield back. I thought I saw Mr. Timmons. I was going to recognize him, but he seems to have gone to vote. Mr. Timmons, if you're ready, I would recognize you and then I'll close. It's up to you.
Yes, sir, Mr. Chair. Thank you. I really appreciate the opportunity to ask questions. Thank you for holding this hearing.
The gentleman from South Carolina is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Griffith, the CFPB worked on debt collection rules for nearly 7 years under the leadership of both Richard Cordray and Kathy Kraninger. The rules were finalized under Director Kraninger and have significant consumer protections such as new call limits and strict compliance requirements around sending texts and emails. Would consumers and industries benefit from consistency moving forward now that there are clear rules of the road?
Thank you, Representative Timmons. You raise a very important question. Under those provisions, if a banking institution wants to reach out to a customer, say during a time like we've seen this past year, to offer them alternatives to their existing loans, they actually cannot do so. It's a violation of law. They cannot reach out with those offers through the text messaging system. And really, this is one of the ways in which we really want to help consumers. We can do this just by rolling back that regulation in and of itself. Banks, lending institutions, they want to help people avoid going into default and going into bankruptcy. This is a great way to make it easier for those institutions to reach out to those with whom they already have a pre-existing client relationship.
Thank you. My wife gets so many texts and calls from people asking for campaign contributions. We probably need some call limits for that area of the law as well. On a more serious note, Mr. Griffith, how would you say the average consumer has fared during the pandemic?
Thank you again. That really varies both by geographic area and the sector. Those that are in professions such as myself, a former lawyer, those that have those white collar types of jobs, overwhelmingly, they've been able to work from home, even if their communities are shut down. But if you're in the service sector, if you're in, say you worked at a theater or a restaurant or a bar, your life in many parts of the country has been severely impacted to the point of you not being able to go out and even earn a living. But that also varies from state to state. You have a number of cities and states that are reopened where unemployment is now under 3%. In South Florida, if you visit there for a weekend, you'll see the bars and the restaurants are absolutely packed. People that are in the service sector there are earning a solid living. And that stands in such stark contrast to those in New York City or Chicago, where if you're in that service industry, you have been laid off in most cases for a very long amount of time. And a lot of them are having to consider leaving and pursuing opportunities elsewhere. So it really varies by sector and the state in which you're located. Reopened states are doing far better, and a number of them are actually in an economic boom.
I've been saying ever since COVID first started that if the government's going to shut you down and not let you work, the government has an obligation to make you whole. And I just wish that we were targeting our economic relief to only people that have had been adversely impacted by COVID, that have been put out of work. In many instances, hundreds of millions of dollars have been spent to people that have had no adverse economic impact. And I think that that's a lesson that I hope we will learn going forward. One more question. What are some of the patterns in consumer spending that have emerged during the pandemic?
Thank you. Well, we've seen a lot of consumers focusing their spending on their homes themselves, because you can't, in parts of the country where people haven't been able to go out and participate in the typical entertainment that they would have, going out to eat, going to a movie theater, or taking a vacation, they still have those resources, and consumers have chosen to really bolster their at-home spending and those possessions, or in many cases actually paying down their debt or saving the money. So it's going to be very interesting to see as more of the nation opens up over the next several months, where that burst of spending might be. And it really might be a lot of people making up for lost time, going out to eat more often, and taking more vacations because they've been denied in many parts of the country that opportunity for a year now.
Like most Americans, my wife and I experienced the cost savings of cooking at home. It really was incredible the amount of money we saved. And I'm just happy that South Carolina is reopening and we're able to get back out and support the local economy. We need to open as quickly and as safely as possible. We got to get our kids back in school. That's the only way that we're going to overcome this pandemic. So I appreciate you taking the time. And Mr. Chairman, I appreciate you holding this hearing and look forward to working with you for many months to come. Thank you. I yield back.
Mr. Timmons yields back. Mr. Kustoff, if you're ready, I'll recognize you for 5 minutes.
Thank you, Mr. Chairman. Thank you for convening today's hearing, and thank you for your leadership today. If I could, and I do want to thank all the witnesses for appearing today as well, virtually. Hopefully we can get back to the time where we can do this live. Mr. Griffith, if I could, I know you touched on this in your written testimony. Could you compare, if you could, the consumer circa 2008, 2009 to the consumer now during the pandemic? Does one fare better than the other?
Sure. Thank you, Congressman. It is night and day looking at the typical consumer now versus during the Great Recession. And this really shows up when you look at the delinquency rates. When it comes to mortgage delinquencies, I think that's where it really shows up. We saw mortgage delinquencies just go up about 0.4% during this pandemic. It was a modest increase. It's still around 2.8%. During the Great Recession, during that financial crisis, we saw the default rate quadruple. And it was actually at a rate that's about 6 times the default rate that we see now. And we've seen repeating patterns of that. If you look at just standard credit card default rates is low. The default rate during the Great Recession soared from about 4.6% to 6.8% on overall credit lines. And we're actually near a record low in delinquencies during this crisis. And the other big difference too is just at the rapid pace of recovery. It took years to recover from the Great Recession nationally. And within 1 year, we see 8 states that are actually bigger now economically than they were a year ago. So it's very varied based on the reopening process, but definitely night and day between now and 10 years ago for the typical consumer.
Thank you very much. And touching on some themes from today's hearing, as it relates to debt collection and debt collection services, if they're further restricted, can you talk about the impact, Mr. Griffith, as to small businesses, those that need those debt collection services? What is the impact of those small businesses?
Thank you. Yeah, for many small businesses actually rely on debt collection agencies to collect bad debts. And often these are servicing those that don't have access to competitive rates to additional credit. Think about auto repair centers, for instance, a number of retailers, financial services, doctors' offices, landlords. All of these folks have the option to actually extend credit to their clientele. And they do that with the knowledge, with the comfort that if that customer ends up not repaying, they can at least get some of those debts back by selling it to a debt collector. If you handicap the ability of debt collection in general, you might be trying to help those that are in dire financial situations. What you're actually doing is you're impacting those small businesses. You're making it harder for them to extend that credit in the future. And long term, it's going to make those who need credit the most even less likely to be able to obtain it from their local business person.
Thank you very much. If I could, Mr. Griffith, also, as it relates to the landlord-tenant relationship with rental assistance and rent being deferred, talk about the impact. And I'm not talking about large apartment corporations. I'm talking about these mom and pop apartment owners who have X number of units. What does it do to them in terms of their debt service and maybe property taxes?
Oh, sure. This is a very important question for those that have just a few rental units. A lot of folks in retirement, they've saved up, they've bought a duplex, maybe 2 duplexes, and the mortgage is mostly paid off, and they rely on that to supplement their Social Security. Over the past year, many of these individuals haven't been able to collect any rent at all. And like we referenced earlier, that's not necessarily because of the people in the units can't pay. It's that now there's an assurance that they cannot be evicted if those payments aren't made. And that's a very real threat to them. And for those smaller investors that look to investing in small pieces of real estate in order to have a secure retirement, this is going to give a lot of them pause for concern, because now we have this precedent set where from Washington, D.C. even, there can be executive orders put in place or even legislation to suspend these moratoriums. Evictions serve an important purpose. No one wants to be evicted. We don't want to see that happen to people, but it ensures that we have an adequate supply of affordable housing for millions of people, because landlords know that if somebody doesn't hold up their end of the bargain, that they're going to have to move out. That's just the foundation of the rule of law.
Thank you very much. I yield back my time. Thank you, Mr. Chairman.
Thank you, Mr. Kustoff. You yield back. I don't see anybody else, so I guess I'll recognize myself for 5 minutes to close, and maybe we'll be done by noon. So I'd like to start with a question for you, Ms. Sanchez-Adams. In your testimony, you stated that during this health and economic crisis, debt collection default judgments have risen and post-judgment collection activity has also intensified. You also noted that some debt collectors are seeing record profits during this period. Is the court system more difficult to navigate for consumers at this time, and are debt collectors taking advantage of this situation?
Absolutely. And I'll tell you a story. So I had a client who was sued on a debt at the very height of the pandemic at the end of March. She wasn't served until May. And then when she was served, she didn't know what to do. So she called the court and she told the court, hey, I have a lawsuit, debt collection lawsuit. It looks like it's for a bank account and I don't owe any money to a bank. They said, oh, you called the wrong court. You must be wanting this Justice of the Peace Court. And they gave her that number. She called them and they said, we have nothing here for you. I think you're mistaken. Call the other court. She called the other court. They said, well, there's no hearing date. Why don't you call the attorney for the plaintiff and talk for the bank and talk to them? So she called the attorney for the bank and said, this isn't my debt. I don't owe this. And he said, well, you're still going to have to pay. So, I don't know what to tell you. All this time, she didn't know she's supposed to file an answer, but she keeps calling the court and asking them if there's a hearing date. Now, if it wasn't, if the courts weren't closed, she would have been able to go to the court and ask and say, and they would have been able to write down an answer for her, which is generally the case with our clients, or even refer her to us or someone else. But 6 months later, she got the referral to us. By that time, there had already been a default judgment, a motion for the default judgment entered, and they got a default judgment against her. Luckily, she was fortunate enough to have us to reopen that case, but that isn't the case for most consumers. And I also just wanted to comment, if I may, on the credit reporting aspect, because there were so many things that were said that were not truly accurate. So the first thing that I wanted to say is that everyone is saying if this information isn't on the report, then it's not, it's not accurate. It doesn't assess somebody's credit risk or credit worthiness. And that just simply isn't true. Things like medical debt are not accurate indicators of credit risk. That's something that's unplanned. It's something that usually is catastrophic. It's the same for events like this. And so if you do put a moratorium on these kinds of debts that don't really reflect on someone's credit worthiness, you still have all of the past history there. You still have, if you do that for the pandemic, you still have the last 7 years worth of credit data to determine whether someone is a credit risk or not. And I'll just say, for example, when I was getting married, I lived in my apartment complex on my own. I qualified on my own. When my husband was going to move in, and he paid more money than I did, but he had no credit. So they forced us to get a co-signer. But there's no credit risk there because I was already there on my own, and adding a new person who had more income isn't indicative of credit risk. The other thing is that the industry is rife with inaccuracies as it is. As you know, the CFPB's top complaints time and time again from consumers is credit report inaccuracies. And you also see that there are no mandatory requirements for reporting. So actually, there's a lot of data that does exist that isn't on there and isn't truly reflective of a consumer. So I'll just say that, everything that was said on credit, taking this off and that showing, being detrimental is absolutely untrue.
Okay, thank you for that testimony. I'd like to turn to Ms. Schultz-Wilson and Mr. James, ask you a question about small businesses. The pandemic has been devastating to small businesses around the country, particularly harmful to businesses led by people of color. What challenges are small businesses and nonprofits faced with during this crisis, especially for those of minority communities? And I'd start with you, Ms. Schultz. Wilson.
Thank you so much for that question. I would say that the biggest challenge, not only for nonprofits and some small businesses, is occupancy cost. And they are really struggling trying to make ends meet. And many nonprofits, particularly the grassroots nonprofits, did not apply for PPP, primarily because they thought it was a loan and that it was not going to be forgiven. And so is the case with a lot of minority small business owners, particularly those that are located in the minority communities. They were not clear that PPP was for them. They thought it was going to be a loan that was going to have to be repaid. And many of them still did not have access to banks that were willing to give them loans. And so they struggled, and nonprofits are continuing to struggle. I mean, many of them have gone out of business. They've closed their doors because revenue is down, donations are down, and they don't have the resources necessary.
Thank you. My time has expired. I have about 1,000 questions and a few responses for you, Mr. Griffith, but I will yield now to the gentleman from New York, the former chairman of this committee, the chairman of the Foreign Affairs Committee, Mr. Meeks.
Thank you, Mr. Chairman. It's good to be with you on this very, very important hearing. And I don't know if it's your first or second one, but I'm proud to be on your subcommittee for sure. My first question goes to Robert James. Research has shown that minority banks and community development financial institutions play a significant role in extending financial services to underbanked communities. And because of their effectiveness in hard-to-serve communities, we must not lose sight of the hurdles that MDIs and CDFIs face. Unfortunately, a recent study from August showed that there was a 41% drop in active Black-owned small businesses compared to a 22% decline overall. And on top of that, the uncertainty that the pandemic brings, the number of MDIs are already declining, and the average assets are significantly less than traditional banks. So investments and grant programs are crucial to seeing MDIs and CDFIs. Can you explain how additional capital investments into MDIs can ensure that hard-hit communities are not only protected through this pandemic, but also enjoy the benefits of our eventual economic recovery in an equitable way?
Congressman Meeks, thank you for that question, and thank you for your continued leadership on these issues around MDIs and CDFIs and making sure that we have access to capital so that we can serve these communities where they've been underserved due to systemic inequity for decades. So, as I mentioned in my earlier remarks, as you suggest, Tier 1 capital is really the lifeblood of any bank, any institution that makes loans and makes credit available to consumers or small businesses. And so additional access to Tier 1 capital in MDIs and CDFIs is critical to us being able to scale up, to be able to extend our services to even more communities in need. Our institutions are at the very, very front line, and in many institutions, they've been there for over a century, providing access to capital and credit, especially in the Black community. And so additional funding for the CDFI fund, the Emergency Capital Investment Program that has just been rolled out from the Treasury Department, as well as continuing to encourage large financial institutions to make investments and provide grants to MDIs and CDFIs. We think that will enable us to exponentially increase our impact in the communities and hopefully eliminate the racial wealth gap. Because as you know, eliminating the racial wealth gap would add $5 trillion to the economy in the next 5 years if we could close that racial wealth gap. And so our institutions are laser focused. The MBA is laser focused on trying to eliminate the racial wealth gap. And we welcome the partnership with your office, as well as the subcommittee and the committee on solutions to get more Tier 1 capital to our banks so that we can work hard on eliminating this racial wealth gap. for the benefit of not just these communities, but all Americans.
Thank you so very much. Let me ask Ms. Harrington a quick question. The pandemic has had a monumental effect as far as a desperate impact on Black businesses and minority communities. And many of them have to make decisions on whether or not they're going to pay off their debt or pay to keep a roof over their heads. And the bill collectors, the debt collectors continue to, crack down on them. So it's imperative that we give them some help. So what would be the 3 top specific policy proposals the federal regulators in the Biden-Harris administration should prioritize to eradicate unfair debt collection practices?
Absolutely. Thank you for that question. And I think it's important to remember that unlike some of the things we heard today, small business owners are the ones who are being dragged into court by debt collectors. The debt collecting industry is actually booming right now. As when other industries are failing, it is booming and bringing in record profits. So what we can do is, one, we need to have a moratorium for the crisis to prevent these debt collection, prevent repossessions, so that people can maintain and make it through. We need to strengthen debt collection rules. Strengthen the recent debt collection of the CFPB was definitely not strong enough. We can have stronger consumer protections for folks facing debt collectors. They should not be able to be harassed. Earlier, there was this conversation about they should be able to text folks. No, that lenders folks, preventing that.
Thank you very much. I yield back to the gentleman.
Thank you, Mr. Meeks. You yield back. I think Mr. Luke DeMeyer, that's Mr. Meeks is the last member on our side to want to ask questions. Do you have anybody else on your side?
Mr. Chairman, I think we're finished as well. Thank you for a great hearing. And again, congratulations. I look forward to working with you. All the best.
Thank you. So to the panelists, ordinarily we would bend over or we lean over to one another and we would say that whether we had more witnesses or more members or whatever. So in a remote setting, you kind of have to ask questions straight out. So thank you all to the panel, very professional witnesses, and we appreciate the testimony of everybody. Your testimony today will help advance the important work of this subcommittee and of the United States Congress in protecting consumers during this pandemic. The chair notes some members may have additional questions for this panel, which they may wish to submit in writing, and without objection, the hearing record will remain open for 5 legislative days for members to submit written questions to these witnesses and to place their responses in the record. And also without objection, members will have 5 legislative days to submit extraneous materials to the chair for inclusion in the record. I remind members to submit written questions and materials for the record to the email address provided to your staff. Again, thank you to the witnesses. It went pretty smoothly, even with all the votes that were being taken. And so thank you very much for your testimony today. This hearing is adjourned.